Good morning, students. I am CA Amit Bhatia, and today we are going to start with the topic of international financial management. In the previous session, we had covered forex exposure and risk management. So, in a way, this is one step further on developing or building on that particular platform, because now we know how forex essentially is dealt with. We can now explore the concept of international financial management. So what do you mean by international financial management? Strictly speaking, you have already learned what is financial management in CA Inter, right? Now, what is the meaning of this particular word? So it's basically nothing but financial management plus foreign exchange being added into it. Meaning, managing your finances, financial management in the international markets, right? So, how does this have an implication? Now, say for example, in current times, you might have heard about 3 to 4 years back, prior to COVID era, in let's say around 2018 or something, one of the biggest companies in India, RIL, right? They were having some huge borrowings in their books, right? That was all INR based. Indian banks, INR based, huge borrowings. Now, huge not in comparison to their balance sheet, right? However, huge borrowings, when I say in terms of it was something like 30 to 40,000 crore rupees. What RIL did was they repaid this entire loans. They repaid them all, right? Completely. And it became zero debt company. Thereafter, RIL reached out because remember, as a zero debt company, their credit rating obviously improves, right? So they went to international financial market. Now, this is the time when, remember, US banks or the Fed rate at that time was just around 0.25, 0.5% at best, which meant that they were getting these loans at very cheap rate. However, these are loans which are dollar denominated loans, right? So while earlier they were paying probably maybe average cost must be somewhere around 7 to 10%, right? Now their average cost had come down to something like 2 to 4%. Of course, one important aspect is that this is all dollar denominated. So as long as you have essentially hedged your foreign exchange outflows in future, you are still in a position to save some money over here, right? Because this is a huge margin. If you look at it, almost we are talking about 5 to 6% margin in between. Isn't it? That's a huge cost saving. This benefit is available to a company when it is going away from Indian market to an international market, right? Because the rate of growth in the countries are different. The cost of borrowing is different in different countries. And this is just one example why we should be learning more about financial management plus foreign exchange, meaning international financial management, right? So here you have various aspects which are going to be involved as far as financial management is concerned. What are the different aspects which we will consider over here, or the factors which may have impact on international financial management? So you will have something like, obviously, your forex risk. Now you have learned in the previous topic how to cover your forex risk, right? You can hedge your risk by way of internal hedging or external hedging. Since your loans are going to be international, You may probably go for futures, options, or one of the combination of those, right? So you may have forex risk. Then you will have the risk pertaining to forex regulations, right? Because now that you are raising funds from an international economy, you will definitely be governed by that particular country over there, right? So whatever are their regulations, including whatever are the forex regulations in your own domestic country as well. So you are essentially getting impacted or affected by both the regulations. Further, political risk. In today's time, we cannot undermine this particular aspect, right? Because the moment it was announced that the new president, incoming president in US is going to be Donald Trump, you essentially noted that equity markets essentially reflected very, very positively. They looked at it very positively because they believe that this appointment is going to be pro-business, right? Also, at the same time, there was a certain amount of anticipation at that particular point that as soon as Mr. Donald Trump, the President Donald Trump essentially takes over sometime around Jan 2025 as the President of US, majority of the US companies will start taking their or repatriating their capital back from other companies or other countries and taking it back into US because it will become more and more pliable to have your capital in US because more opportunities will be coming in. And you know, Trump as a president has already been, right? He is the incoming president. He's already been announcing there will be a lot of tariffs which he's going to impose on this country, that region, etc., etc. So they anticipate that as a result of that, if I'm going to manufacture outside US and essentially bring that products into US, it may become more costlier. Instead, let me have that particular thing done in US itself. Similarly, he's also said already that he is going to start with the fracking. Fracking is essentially about exploration of oil from Texas region, right? Which President Biden had essentially banned. Now, President Trump, who had already done that in the previous term as well, he is going to restart that particular process of exploration of oil and whatnot, irrespective of what the environmentalists are saying over there. So that basically underlies or underscores the importance of this particular element right now, right? If you look at India, we also have a certain political risk in terms of that earlier, if any particular, say for example, decision was to be made, the government at the center, right, at that particular point it's called NDA, right? However, BJP had its own 303 something strength, which meant that they had the full majority on their own, and plus their allies, that obviously improves that tally, right? I think it was 270, about 270 or 280 or whatever. BJP was having the strength on its own. Now BJP has almost 240 or 44 something, right? Plus their allies, and they are able to cross the 272 mark. Now, what does this do? Again, there is a certain amount of political uncertainty, right? Because if the major party fails to enjoy the support, maintain the support and confidence of their allies, then in that case, this government can get toppled, or if not toppled, at least they will not be able to pass important initiatives which they want to pass, right, as a government. So those political risks are continuing. Again, in the business perspective, remember, if Donald Trump comes, and Donald Trump again, just a couple of days back has made another announcement that all the BRIC nations, BRIC, right? So we have BRICS nations, BRIC, that is Brazil, Russia, India, China, and South Africa, BRICS nations. And now another 6 nations have added into that, including UAE. He has said that if you opt for de-dollarization, we will go for 100% tariffs. Now, obviously, considering Russia, along with China and India, are part of that particular pool, it's not going to be easy for US to essentially have 100% tariffs either, right? For the simple reason, India and China taken together, they are the, you can say, third, and China is the second biggest economy. India is fifth biggest economy, right? From the total GDP perspective. As a result of that, a lot of the goods are getting imported into US from these economies, and that will also obviously have a ripple effect in their own local markets as well. Inflation in that case will rise in US as well. So obviously he is going to do it selectively, but nonetheless, going by what he's already trying to sense, it does create a certain amount of uncertainty, political uncertainty, right? And that becomes a risk for us. Next is export cannibalization. Now let me explain this cannibalization term. Are you all aware about what is this cannibalization? Yes, anyone? Okay, let me explain that in that case. Say for example, I am already a manufacturing company, okay? I'm a manufacturing company who is manufacturing, say for example, shoes, okay? And the shoes brand name is, say for example, ABC. This is my brand, okay? This is my ABC brand, and I have a sales of, let's say for example, 50 crores in the year, INR, okay? 50 crores in the year. Now I realize that my brand is basically considered to be, you can say, middle class to lower middle class people essentially opt for my brand. So it's not considered as a luxury product or as a precious commodity, though the quality which I serve is very good and whatnot. Yet there is a particular perception, and in order to get out of that perception, what I do is I come out with another shoe. Say for example, I call it as XYZ, which is being branded as a premium shoe, right? So I brand this one as a premium shoe company. Now I am anticipating that this is obviously going to give me access to different market. And when I say different market, meaning from the market segment perspective, as I just said, generally my shoes are purchased by people who are from lower middle class and middle class families, or even if the higher class families are taking it, they are taking it for very, very basic rudimentary purposes only, my shoes. But when it comes to the events which are very important, etc., in their lives or in corporate life or whatever it is, right? So in that case, they are not opting for my shoes. So I have come up with this new brand XYZ, which is luxury brand, right? Now I'm anticipating this is going to give me additional business, right? So say for example, this gives me a business of another 15 crores. Now, going forward, 15 crores is the new business generated by XYZ. I also notice that out of this 50 crores, now 5 crores of my business has come down. It has become 45 crores. And the reason for that is people, my customers, existing customers who were buying my existing ABC shoes, they also started upgrading themselves, moving from ABC to XYZ. So while I have done a new business of 15 crores, I have lost business of 5 crores because these customers essentially they upgraded themselves to my product only, XYZ. But nonetheless, that means for getting this new sale of 15 crores, there is a cannibalization factor of 5 crores because my existing sale got reduced because of this new XYZ product. So this is called cannibalization, right? This is the loss which I am making where my existing business takes a hit because of the new product, etc., which I am launching. Now, what do you mean by export cannibalization? The same thing happens with export cannibalization also when you start doing exports, etc., which means I am coming out with a new brand, etc. My existing sales, which I am doing of different products, may also get adversely affected because of this particular factor, right? So say for example, if I'm already selling this in international market, ABC, there is quite a possibility that my customers may now say, I don't want to go for ABC, but rather I would like to go for XYZ. So I lose out this 5 crores, which is cannibalization factor, right? Now, what are the aspects we are going to cover over here in financial management? So when we talk about financial management, of course, international financial management, I'm talking about over here. right? So which elements are going to get covered and captured over here? So I'm talking about, first is obviously how to raise funds. What are the options I have generally in raising funds when I talk about international market? So here, obviously, I have the options of equity and then debt, right? When I talk about equity, my shares, equity shares of Indian companies are listed in the Indian stock exchanges, which are trading in INR terms, rupees. So if I want to go and sell this particular share in the international market, nobody is going to be able to trade it, right? Say, for example, I want to access a bigger market, which is US stock exchanges, which is Nasdaq or New York Stock Exchange or MX, American Stock Exchange, that is, right? If I want to access those international markets, I will not be able to access it because my currency is INR. They are trading securities on dollar terms, right? So that makes it very difficult for me to get the funds. So the solution over here is essentially called as ADR, GDR, or you may say IDR. American Depository Receipts, Global Depository Receipts, Indian Depository Receipts, right? On the other hand, you have debt. So there are various bonds which you can obviously issue, right? Bonds or debentures. And of course, you can always opt for loans. Now, I will just introduce this four concepts first of all, and then we will deep dive into one at a time. And then obviously we will start solving the numbers or questions so that you can relate to it, right? As to what and how are we essentially getting into this, right? Pooja, are you able to hear me? Pooja, Pansha?
Yes, sir. I just joined this session.
Okay. Good morning, dear.
Good morning, sir.
All right. So now we have started already with financial management, right? So first option is how to raise fund. Second one, obviously, is very important topic. You might have already solved this topic earlier as well during financial management, which is capital budgeting. Now, you have already learned what is capital budgeting in your CA Inter as well, right?
Yes, sir.
Here, when we are going to talk about capital budgeting, we are going to talk from the foreign exchange perspective, right? So, say for example, I am an Indian company who is going to come up with a project in, let's say, you have heard about, let me give you a practical example. Currently, when a lot of issues are being reported, political unrest, etc., is being reported in a country of Bangladesh. And immediately thereafter, you might have also heard about that Bangladesh is essentially having kind of a 50% of the Bangladesh is having a blackout because the company which was supplying electricity, which is Adani, they have essentially stopped because they were not receiving their payments. Right? Now, again, this is an example of capital budgeting, right? Adani is an Indian company having a plant or setup in Bangladesh, and then they are essentially distributing electricity to the diaspora over there. So this is an international project. Same goes for a lot of these infrastructure projects which Indian government has also been doing, right? Like for example, in country of Maldives, India is already building a certain bridges and infrastructure right over there. They are also laying down certain train tracks and selling them, or rather providing them on a very, very, you can say, uh, easy and convenient aids, right? Financial aid, so that they can have those infrastructure projects, etc. That is again a capital budgeting project. We are essentially going to look at it from the business perspective and identifying whether the required rate of return is essentially being met or not, whether the project is viable or not. That is capital budgeting. The third, yes, dear. So Here again, I will have capital budgeting transactions. That is, we are going to have international projects. When I say international projects, obviously that means involvement of Forex, right? And then in order to convert these, I will need to apply the two parity principles which we have learned in Forex. Which were those two parity principles? Interest rate parity and purchasing power parity, right? So how we use them, we will see that when we actually get into the questions. But I hope you recall what is interest rate parity and purchase power parity, because we have done that just last week, right? All right. Next is working capital management. Working capital management. Now, when we talk about working capital management, what are the aspects we normally talk about? First is obviously cash management. Am I right? Cash management. Because I will have my debtors and creditors, my outstanding inventories are going to be there. So should I maintain my inventories in international currencies? Should I have more or less of it? Of course, your inventory decisions are also based on how your procurement cycles are there, etc. Right? But it will also have an important element of what is the amount of investment which is going to get invested in it. I'll give you a very simple example why this becomes very important for us. Now, uh, when you travel to, say, for example, a country like, let's say, Denmark, Copenhagen, okay? So I go to a country like Copenhagen, okay? And let's say I'm in one of the cities in India. So let's say I'm in Mumbai, or let's say I'm in Delhi, right? I'm buying, say, for example, half a liter of water bottle, half a liter. Now, this half a liter water bottle in India is generally available around rupees 10, right? Probably 1 liter bottle will be available to you for around rupees 15, or at best 20, 15 or 20, depending on whether you are buying at railway station or you are buying in some shop, etc. But maximum price is rupees 20. In CPH, in Copenhagen, Denmark, here your half a liter bottle is costing you normally, currently prevailing, just for your information, Copenhagen has international currency which is called Danish kroner, right? They obviously accept euro as well, but this is their national currency, and they have 1 DKK which is equivalent to almost rupees 11 to 12. Okay, that is a range in which it keeps on fluctuating. So if I take 1 DKK is equal to rupees 11, this water bottle, logically speaking, should be available to me at a price which is less than 1 kroner. Do you agree with me?
Yes, sir.
However, any guesses? What is the price of this particular water bottle in Denmark? Any guesses? Any ideas? You would be surprised. It is DKK 10, right? And when you are taking a 1 liter bottle, it is costing you DKK 20. Now you realize over here, there is a huge opportunity for me, don't you think? If I can just take this water bottles from here and take it to Denmark, it will be a huge opportunity for me. Probably transportation cost being added into, let's say, for example, even if the transportation cost comes to even 50 rupees, hypothetically, per liter of water, I can still sell it in the DKK at maybe 9 DKK, etc., because this is 110 rupees, right? So as long as I am selling it less than 10 DKK, I will make a good amount of money. However, I am not able to take the water over there and sell it over there for the simple reason there is one important issue of political risk, right? Because they do not allow importing of water over there. There are certain restrictions on it. Then again, since they cannot expressly deny, what they do is they try to come out with certain quality standards, etc., by which other countries will not be able to supply water to them, right? But locally, retail price is 10 and 20 DKK. Now, here, if I am somebody who is into business, who is getting a particular resource between these two countries, this is just an example which I gave you about water, but there could be various other instances, right? Then in that case, working capital management becomes a very important element for me, because the moment I'm talking about uh, any particular such resource in international times, let's say, for example, I'm manufacturing my intermediary product in China. Should I have that particular product imported in, say, 10,000, 20,000? Then you know for a fact you will essentially try to identify. Remember, in another subject, you are learning assignment problems, right? In your OR, operation research. So you try to identify what is the best quantity that you should essentially import, which will be the most economic quantity for you and logistically viable, both logically and logistically viable quantities for you, right? So same thing happens over here as well, and that is the reason cash management, inventory management is very, very important over here, right? So cash management, inventory management, right? Further, you will also have something known as netting. You remember we have learned this in the forex exposure. This is one of the internal techniques of hedging. Hedging had two types of techniques, internal technique and external technique. On this, we had also done a question. What this basically says is if, say, for example, I have a transaction, or let's say, for example, I have a creditor in US. These are both in US. I have a creditor and I have a debtor, right? So, say, for example, if I have a creditor of $50,000, right? And I also have a debtor of $50,000, where the payments are due around the same date. Then in that case, I can net that off and I don't carry any risk, right? Because whatever I will receive from the debtor, I will pay to the creditor and my liability is zero. So this particular part, netting, is very important. Along with netting, we had also learned the concept of matching. Remember, what is matching? When you don't have the same due dates. Say, for example, this creditor is happening to be due on 31st of March, while this debtor is due on, say, for example, 30th of April. So I have a payment to be done 1 month prior to my asset, which is going to become due. So then in that case, for the differences, I might try to protect myself by taking a forward cover or options, as the case may be, right? So this is as far as your cash management is concerned, which is very, very important for your overall function of treasury management. Are you all with me? Right? And the last or the fourth part is dividend decisions. I believe you already have learned again this also in the intermediate, right? Whether we should opt for payment of dividend, which is your dividend can be either you are paying, well, we used to do comparison, remember? R is less than K, R is equal to K, or R is greater than K. What is the optimum dividend payment strategy? Do you remember that? Yes. When your rate of return
Yes,
created
sir.
by the business is equal to cost of capital, then you are indifferent. Then it doesn't matter. You are indifferent whether you pay out dividend or you don't. But when your R is less than K, meaning your cost is more than the rate of return you are generating, then in that case, your investors are going to expect that you pay entire profits as dividend, right? Because then at least you are not losing out on the money part. When your R is greater than K, your investor will essentially be happy if dividend is less or even zero. Why is that so? Because you are multiplying and using that money to generate higher return compared to the cost of capital, right? So this
Retained
is
earnings.
your dividend decisions which the company will take. Company is going to take the decision based on, remember, on its own, based on its balance sheet effect, right? Rather than what is good for the investor. However, again, if business is able to generate return which is more than the cost of capital, I am more than willing to plow back my profits, give more money to it. Yes, dear. It is Gordon model. Gordon dividend model is there. Yes, that is for valuation purposes also, right? So this basic principle is applicable when it comes to dividend decisions, right? And that will apply in international financial management as well. Okay. All right. Now let's go the first thing at a time. So we are now going to deep dive into ADR, GDR, and IDR. Are we aware about how the ADRs are issued? Yes. Are we aware about how ADRs are issued? I'm starting with first aspect, which is ADR. Okay. So why does ADR come into being? So what is ADR? Before I talk about what is ADR, let me put you a situation. So I have an Indian company. Probably the situation will explain the things a lot better, right? What is ADR and why do you need ADR? So I have an Indian company which is listed. Okay. It is listed company on stock exchange in India. Now it wants to raise money, right, from investors, say for example, in US. I want to raise money from investors in US. Now these investors are willing to invest in your company. However, the challenge is your shares are rupee denominated and they are essentially having dollar to deal with, right? And what they want is that while you give them the shares, like in a lot of the cases it happens, okay, if it's an unlisted company, you are just going to hold on to it, then not a problem. But no, here the objective of investors is they want the benefit of marketability of shares, meaning they should be able to buy and sell shares in their local market. So they should not be tied down with these shares. So just like any other equity shares they would have in US, they want that they can buy these shares and sell these shares in the US market. In US, you have three stock exchanges, as you know, the prominent ones, right? NYSE, then you have NASDAQ, and you have MX, right? So they are expecting a security which can be listed over one of these exchanges so that they can essentially enter and exit anytime they want. The challenge is you can't enter the US market directly. So then in that case, what you do is you reach out to a foreign bank which is in US, which is called Overseas Depository Bank. It becomes an intermediary between the two, right? It becomes an intermediary between these two entities, right? So what they will do is now Indian company will issue their shares, equity shares, to Overseas Depository Bank, and Overseas Depository Bank will essentially issue what is known as American Depository Receipt. So what is this American Depository Receipt? It is a receipt which is going to have an underlying asset. And the underlying asset is, what is the underlying asset? Underlying assets is equity
Indian
shares of
company
Indian,
shares.
right? Indian company. So it will give this ADR, which is dollar denominated, to investors in US. Investors will give money, dollars, to Overseas Depository Bank. Overseas Depository Bank will transfer this money to the Indian company by saying, from dollars, I am going to subtract something known as issue expenses, charges, etc., which we generally call it as flotation cost or issue expenses, right? And the net proceeds, that is, so net proceeds will be given to the Indian company. Now there is one challenge. And what is that challenge? The challenge is these shares which are issued in the Indian company, whether they have been issued as per all the process, etc., or not, or when the shares are essentially being handed over from Indian company to the Overseas Depository Bank, right? There is a huge time gap which is required. And that can essentially mean a lot of changes in the forex fluctuations. So what happens in that case? What happens is basically this overseas depository bank, because it is in overseas, right? What they do is they are not going to bring these particular shares in America. Why? Because it is a Indian asset which is denominated in rupees. Any which ways, if I bring it to US, I will not be able to trade on it. It becomes a difficult over here to maintain it. If I want to ever liquidate it, I will not be able to liquidate it. I will have to again send it back to India, then liquidate it, right? So instead of that, what this overseas depository bank does is they appoint one of their own banks in India as their agent. And
Custodians.
what are they known as?
Custodians.
Yes, domestic custodians. Okay, all right. Since you already know, I will go slightly faster in that case so that we go to the questions in that case, right? So these shares will not be going over here. Instead, the shares will go over here, right? So shares will be transferred to domestic custodians over here. Domestic custodians give confirmation that yes, I have received so and so shares to their overseas depository bank, and based on that confirmation, they will start issuing ADRs to investors in US. Now, this ADR will be listed in NYSE, Nasdaq, MX, respectively, one of the stock exchanges. And what benefit it brings to the Indian companies? Now my shares are listed on US because this is a international market which is worth trillions of dollars. So I have access to a bigger capital market compared to just the Indian capital market, right? So that is the benefit. Now ADR, as the name itself suggests, American depository receipts, they are dollar denominated and they are issued in US, American. That is the reason the name American depository receipts. So what is the meaning of GDR then? GDR, G stands for Global Depository Receipts. The process is the same. Underlying currency can be any international currency, any international currency. However, one important logic you have to understand, it can be in pound, it can be in dollar, it can be in yuan or yen, etc. Right? However, you have to understand that when I am essentially issuing global depository receipts, I have to essentially list it in some exchange, right? It has to be listed in some exchange. So what is the currency in which that exchange is essentially transacting? That is going to be very, very important. However, global depository receipts can be issued anywhere across the globe, but not America. If you want to issue it in America, you will have to issue American deposit receipts. Global deposit receipts are not recognized in America. So predominantly, practically speaking, GDRs are issued in Europe, in the London Stock Exchange, etc., right? And other European stock exchanges. So you issue GDRs over there to transact your shares in those markets. And ADRs are used for American market. Now you also have a concept of IDR. IDR stands for same concept, just the reverse. IDR is Indian Depository Receipts. So now if a foreign company wants to essentially issue shares in India, which is denominated in foreign currency, then they will essentially use this particular route. Logically speaking, or the regulation wise, IDR can be issued by any company. So say there is a US company, same process will get reversed, right? The entire process which you have over here, the same process will get reversed, meaning you will have a US company, listed company over there. They will issue shares to their domestic custodian over there, which will be an agent of a overseas depository bank. This overseas depository bank is from Indian perspective, right? So now for India, it will become and bank depository bank in India. And investors obviously will be investing in rupee terms. Logically speaking, will IDR be issued or be accessed by an American company or a country, another country which is having less access to capital? So would it be a developing economy which will take benefit of IDR, or will it be developed economy? Generally, which one will essentially take benefit of IDR? Yes? Any ideas? Which one will take the benefit? developing economies will enter India, or will it be the developed economies which will enter India through IDR? So logically or legally rather, legally anybody can come, but practically the ones who essentially,
Developing economies, sir.
exactly, it will be the developing economies which will take the benefit of IDR to enter Indian markets, because logically speaking, I want to use this depository receipts concept and enter into the market which has more capital access compared to my own local market. So if I already have, say for example, I'm a Chinese guy who already has access to, let's say for example, markets which are of worth $20 trillion. So then in that case, do I want to go to BSE or NSE, which is worth, say for example, $4 trillion? Then obviously no, right? Because I'm already paying charges over there in a $20 trillion economy. So if I'm going to move away from China, I would essentially go to a bigger market, which is, say, for example, US. This is what is happening, right? With most of the Chinese big companies, they essentially list their shares on the Nasdaq, NYSE, MX, so on and such, right? The reason being, you want to go from your smaller capital base to a bigger capital base. All right. I believe everybody has received the assignment. Yes. So let us go to the assignment questions in that case. We'll take up the first question of the assignment. All right. Let us take the question over here. Is this question visible to everyone? Okay. Is this question visible to everyone?
Yes, sir.
All right. Let's start then. So X Limited is interested in expanding its operations and planning to install manufacturing plant at US. For the proposed project, it requires a fund of $10 million net of issue expenses and flotation cost. The estimated flotation cost is 2%. To finance this project, it proposes to issue JDRs. You, as financial consultant, is required to compute the number of GDRs to be issued and cost of the GDR with the help of following additional information. Expected market price of share at the time of issue of GDR is 250, face value 100. 2 shares shall underlie each GDR and shall be priced at 10% discount to market price. Expected exchange rate is rupees 60 per dollar. Dividend expected to be paid is 20% with growth rate of 12%. So dividend is 20%. 20% of what? Of market price or face value? Yes. Dividend expected to be paid is
Face
20%.
value.
Yes. Face value, right?
Face value. Yes, face value.
So in other words, dividend expected to be paid per share is going to be 20 rupees, right? 20%. All right. So here you have one GDR. This is my one GDR. How many shares are there underlying? 2 shares shall underline, right? So 2 shares, 2 into, you are told at the time of issue, market price is 250, right? So strictly speaking, this GDR is having a market value of 500 rupees because underlying asset is 2 shares. However, these are priced at 10% discount to market price, meaning this is priced at 90%, right? So this becomes 450 rupees. Are you with me?
Yes, sir.
Right? All right. Now, remember, this is in INR terms. I need to convert these calculations into dollar terms, right? So, what is the exchange rate over here? 450 divided by 60. So, this becomes how many dollars? $7?
$7.5.
$7.5, right? So, $7.5 is the price of one GDR. So, in order to get $10 million, what they are asking is you as a financial consultant is required to compute number of GDRs to be issued and cost of GDR with the help of following additional information. All right. So let's start now. So first and foremost, what is my net issue size? How much do I need? $10 million. Am I right? Yes. So what is the gross issue? What do you mean by gross issue? How do you get net issue or net proceeds? Remember, what is net proceeds?
Minus flotation cost.
It is nothing but gross issue or the gross proceeds minus flotation cost. Right? So here you are told flotation cost is 2%, gross proceeds is 100. So your net proceeds will become how much? 98%. Am I right? So what is my gross issue? $10 million divided by 0.98. So I get the gross issue. Are you all with me? What will be the value? Can you do the calculation? 10 upon 0.98. In the meantime, I'll also talk about issue price of GDR in rupees. How much will that be? It is going to be 2 into 250. Remember, every GDR is going to have 2 equity shares which are having market price of 250, right? Into 90% because you are going to issue them at discount of 10%. So that gives you 450 rupees. How did we get this 450 rupees? हमने अभी यहाँ पे calculation किया था, right? Now I find the issue price of this GDR in dollars. How much will that be? 450 rupees upon rupees 60 per dollar, right? So I get dollar 7.50. So far, so good. Yes.
Yes, sir.
So now I have to essentially identify first question. What is the first question? First question they are asking is compute the number of GDRs to be issued and cost of the GDR. So we will see first of all how many number of GDRs to be issued. So how many number of GDRs? number of GDRs to be issued. That will be equal to how much is the gross issue I want? Did you find the value? Anybody find the value over here? Divide by 7.50. What is this coming as? 10.2041.
10.2041.
1. Okay, so we will take 10.204 divided by $7.50. So how many number of GDRs are coming? Should be more than 1 million.
1.3605.
1.3605 million. These are, remember, number of GDRs. Okay, 1.3605 is the number of GDRs. All right. Now for the B part. What is the cost of? We are asked what is the cost of GDR with the help of falling addition. All right, fair enough. So उसके लिए मुझे क्या find करना पड़ेगा? What is my cost for me? So I am going to pay dividend. How much is the dividend per share or per GDR, right? Dividend per share is equal to 20% into rupees 100 face value. Am I right? To rupees 20. That means dividend per GDR will be 20 into 2 is equal to 40 rupees. This is the cost. Now, what is the net proceeds in INR terms? Net proceeds for each GDR in rupees. So issue price is 450 rupees, right? कहाँ से मिला ये? You already have got it over here in rupees term. And on this, you will have to pay flotation cost, right? 2%. So balance is 0.98. That comes to how much rupees? Is
441.
441. 441. Okay. 441. So now, what is the cost? Cost of GDR. Cost of GDR. How much will that be? I have to pay 40 rupees dividend, right? Upon 441 is my net proceeds plus 0.12. Do you recollect which formula we are using over here?
So I think it is Gordon's formula.
E1 upon
T0
E0 plus G,
growth.
right? So I am going to pay 40, which is my D1, right, at the end of the year. 441 is what I have raised at the beginning of the year. And during the year, I am supposed to give growth rate of 12%. So how much is this answer coming to? 40 upon 441. That is how much?
.21.
This is 21. 40
No,
upon
including 0.12, it is 0.2.
0.21. Okay.
Final answers.
That is 21%, right? 21 point आगे कुछ है बेटा?
07, sir.
0.07%. Okay. So this is my cost of JDR. Have you all understood this? Very easy as such, right? Let us take one more sum on this. Question number 2. Question number 2. Question number 2. All right. Next question. Question number 2. Messrs. Raghu Limited is interested in expanding its operation and planning to install manufacturing plant at US. It requires 8.82 million USD net of issue expenses and flotation cost to fund the proposed project. GDRs are proposed to be issued to finance this project. The estimated flotation cost of GDRs is 2%. So here, again, what is my net issue size? 8.82 million USD. Flotation cost is 2%. Expected market price of share at the time of issue of GDR is 360, face value 100. Each GDR will represent 2 underlying shares. So I have one GDR which is going to have 2 shares of 360 market price. The issue shall be priced at 10% discount up to the market price. Okay. So again, this will be into 90%. Expected exchange rate is INR to USD of 72 rupees. Fair enough. $1 is equal to rupees 72. Dividend is expected to be paid at the rate of 20%. So your year-end dividend is 20%, growth rate is 12%. You as a financial consultant are required to compute number of GDRs to be issued and cost of the GDR, which was already asked in the first question as well. What is your suggestion if the company receives an offer from a US bank willing to provide an equivalent loan with an interest rate of 12%? How much company can save by choosing the option as recommended by you? So as such, this question is very, very similar. We can do it very fast. 2 into 360 is 720. 720 into 90% will be how much? Equals to rupees
648.
648. Okay. So 648, this is in rupee terms, right? This is rupee. In dollar terms, it will be 648 upon 72. That will be how much? $9, is it? Is it 9? Exact 9?
Yes, sir, exact 9.
Exact 9. Okay. Now, how much money do I want to raise? So my net proceeds is 8.82, right? $million. So gross proceeds will be how much? 8.82 divided by 0.98. Are you all with me? Why 0.98? 2% is the flotation.
Sir.
So 8.82 divided by 0.98.
9 sir, answer.
Okay, this is exact 9 million, right? Fair enough. So now, what will be the first question is, you are asked, compute the number of GDRs to be issued. So how many number of GDRs will be issued? Number of GDRs to be issued equals to, you want 9 million upon $9. That is 1 million. Am I right? 1 million GDRs. Yes, am I right?
Yes sir.
What will be the cost? Cost of GDR कितना होगा? Is equal to, remember, KE is equal to D1 upon P0 plus G. What is that? Expected dividend कितना है? How much is expected dividend? 20 rupees. So it will become 40 upon, what is the P0? So P0 is going to be what? What is the net proceeds that you are supposed to get? So you are going to issue this at 648, right? INR terms it is rupees. But what is the amount you are going to get? Net proceeds कितना होगा? 648 into 0.98. Am I right? Plus 0.12. So how much is the answer? Should be 40 upon. How much is this value coming to? 648. 6.
635.04.
Plus 0.12. So क्या आंसर आ रहा है?
Final answer 18.3% sir.
18.3%. All right. Now you are further given, what is your suggestion if the company receives an offer from a US bank willing to provide an equivalent loan with an interest rate of 12%? Should it accept the offer? Yes. Cost of GDR is, already you have calculated, 18.3%. And you are getting
Yes,
loan
the
at
loan
12%.
is cheaper, sir.
Accept sir.
Will you accept it?
Yes sir.
Yes, we will accept it, right? So you will say yes, you will accept if it is at 12% because it saves you 6.3% in cost, right? So how much company can save by choosing the option as recommended by you? You will say 18.3% minus 12% is equal to 6.3%. Right. Are we through? So these are the basic types of questions on GDR. Now we go on to the crux, which is capital budgeting. Now here in capital budgeting, when I'm talking about capital budgeting, as I mentioned, since there is a foreign element involved, right? So it's going to be a case of a person is there in one country. So there is a company, right? In, say, for example, I call it as parent company. Okay. Parent company is in one country, country one, and it wants to set up a project wants to set up a project in country 2, right? So when you have this to do, we need to essentially find out whether the project will be viable or not. And for the viability of the project, normally when we use the methods of say payback period, net present value, internal rate of return, IRR that is, right? We were always doing capital budgeting earlier. Everything was within the country, meaning everything was expressed in the same currency. Now that you have a different currency involved, the challenges that are going to be there is here you have two different currencies, right? You have two different currencies, you have two different regulations. So as a result of that, two different taxations also, right? Because the proceeds which may come to parent company, now that profit will be taxable in both the countries, in the project or the host country as we call it, right? This is host country where the project is going to be there. So host country and the parent company is there in country 1, which is also known as home country, right? Or domestic country. Because we are doing this evaluation from the parent company's point of view. Home country, or you can say domestic country, right? So two different currencies, you have two different taxations. Also, you have the impact not just of taxation, but you also have something to look at from transfer pricing also, right? What do you mean by transfer pricing? Because normally, say for example, earlier, if I had a country where I was making money which was earning say 30%, here say for example tax rate was 30%, right? And in my parent company, say for example, here the tax rate is 0%, then I would essentially not recognize any revenue in this country. I would take the entire project over here and then recognize the entire revenue in tax rate where 0% is there, so that everything is tax free. But now, due to transfer pricing, you know for a fact that you will have to recognize the value of this project as per certain principles which are given under transfer pricing, right? So you have your transactional net margin method or cost CUP method, cost plus profit method, etc. So you have one of those methods in which transfer pricing applies. What is the challenge for me now? So if I have to essentially recognize some amount of profit in the host country, I will obviously have to pay tax on it. Now the tax may be, what are the taxes which can be there? You may have capital gains, you may have the normal taxes, that is corporate tax, right? May have corporate tax, plus there may also be withholding tax. Now, normally withholding tax is always against the liability of your corporate tax or capital gains tax, right? So, while you are finally filing your return, you always, withholding tax is nothing but TDS, right? So, this always gets adjusted against your other taxes. Nonetheless, I am looking at two projects where the currencies are different. So, say for example, it is a rupee, which is a parent company, and say for example, my project is in a country which is in dollar. Okay. Now here, how do I do the capital budgeting? So there are two approaches which are available to us. Which are those two approaches? For computation of the net proceeds and NPV as such, to compute that, you have two approaches. So approaches to evaluate foreign projects, right? Or you can also call it as overseas projects. What are those two approaches? I have two approaches. First is home currency approach, right? And second one is obviously foreign currency approach. What do you mean by this? Your all the calculations basically will be done based on home currency. You will convert everything into home currency and to the valuation, or you may do all the evaluation based on foreign currency. But basically, to have that particular calculation being done, everything has to be in one currency, one uniform currency, right? So either have it in the home currency or in the foreign currency. So for us, it is important to understand your basically your answer will still come to the almost near around same, except for some rounding of numbers, etc., etc. But approach will have different process steps will be different, right? So what are the steps involved in home currency approach? So first and foremost, I have to estimate cash flows, estimate cash flows in foreign currency, right? This is step one. Step two. Step two is estimate future exchange rates using parity principles, which is IRP and purchasing power parity. IRP/PPP. Now it depends whether you are given the interest rates of the two countries or whether you are given the inflation rates of the two countries, right? Then you have step number three. Step number three is convert future cash flow to home currency. And then last, discount these cash flows using domestic required rate of return. This is very, very important. Required rate of return, right? So this is very, very important to understand what is your required rate of return for the parent company, right? For the home country. So I will essentially discount these cash flows which I have received in my home currency as per my required rate of return. In comparison, the steps in case of foreign currency is going to be slightly different, right? Why will that be different? First of all, you estimate cash flows. Again, estimate cash flows in foreign currency, right? Two. Now here you will find the change. First steps, you can see first step is pretty similar, right? Now in second step, you will find over here there is a change. What is that change? I need to convert domestic required rate of return. You remember over here at the end we were discounting with the domestic rate of return. Here you are converting your domestic required rate of return into foreign required rate of return. So say for example I have rupee based rate of return, then I will convert that into dollar required rate of return, right? That is my step number 2. Then step number 3, discount the foreign currency cash flows using discount rate as per step 2 over here, right? which we already found, foreign required rate of return. So this is nothing but the foreign rate of return as per step 2, which we already computed. And then over here you compute NPV, right? And the last step, after I have calculated everything, I am going to obviously convert this NPV. Convert NPV. Now remember, I have brought everything. NPV is your today, net present value, today's date, right? We have already discounted everything and brought everything to today's date. So obviously, I have to convert this NPV, say for example, which was in dollar currency or foreign currency, into domestic currency, right? Into domestic currency. I need to do this today. Today. So at what rate? At
That's spot rate.
spot rate, right? Very good. So these are my steps. Now, simply if you take the steps in isolation, then obviously it will be very difficult for us to understand, right? So let us take one question and we will do that sum through both the methods. Through home currency approach, and thereafter we will also solve the same sum through foreign currency approach, so that both the methods are clear with us. Now in the examination, which approach to follow? Normally they specifically mention in the examination which approach or method to follow. In the absence of any information to the contrary, then you can essentially use any of the methods, but ensure that you upfront only mention, I am following this method or that method. If nothing is mentioned, you can have your own choice, but if specifically mentioned, then you will have to follow that particular method. Okay, so let's take the question. Just 1 second, please. Because here I need to ensure that the amounts remain as they are. Right. Okay, is this visible to everyone? Question number 3.
Yes, sir.
Okay. Now here as such we are told that we have to solve this question using foreign currency approach. We will try to solve this obviously with foreign currency approach first of all, and then we'll also see how to solve it using home currency approach. Okay? Let's start. Let's start. So ABC Limited is considering a project in US which will involve an initial investment of US dollar 1 crore 10 lakhs. Right? Project will have 5 years in life. Current spot exchange rate is rupees 48 per US dollar. The risk-free rate in US is 8%. And the same in India is 12%. Cash inflow from the project is as follows. Year 1, 2, 3, 4, 5, you are given 20, 25 million, 30 million, 40 million, 50 million respectively. Calculate NPV of the project using foreign currency approach. The required rate of return on this project is 14%. Right? Now, first and foremost, what I need is, what is my step 1? I need what are the cash inflows during the foreign currency cash inflows. I already know what is foreign currency cash inflows, 20, 25, 30, 40 and 50. That was my step 1. It's already given to me. Okay. Now, step 2. So, what is my step 2? Step 2. Yes. What is my step 2? I need to convert domestic required rate of return into domestic required rate of return. I need to convert this into foreign required rate of return. That is dollar denominated. Am I right?
Yes, sir.
Okay. All right. So, how do I basically compute this? So, you know for a fact that my domestic required rate of return is 14%, right? You are already told that. Now, you can see over here, required rate of return on this project is 14%. Now, obviously, ABC Limited is a Indian company, right? Considering a project in US. So, it is an Indian company. In India, domestic country, your expected rate of return is 14%. So, now my rate of return over here, which rate of return over here? Risk-free rate in India is 12%. Try and understand required rate of return is 14% and your risk-free rate of return is 12%. Risk-free rate of return is 12%. Okay. So what is your risk premium? What is your risk premium?
2%.
2%, right? I mean, this is keeping it simple, right? Keeping the things very simple. That is the reason I have taken the example like this. 14, 12. And again, if you want to ask, sir, how did I get that? You have learned CAPM, right? Capital Asset Pricing Model. How do you get that? Risk-free rate plus premium, right? How do you get that? KE is equal to risk-free rate plus beta into RM minus RM. Am I right? What is this basically talking about? This is talking about the risk premium. This is risk premium basically. Again, so your KE is nothing but your required rate of return, right? So over here, you are told 14% is equal to 12% is your risk-free rate and risk premium is this. Now, remember, you are not operating in isolation as 12% and 14%, right? So how do you essentially express this? How do you essentially express this? You say this is 1 plus 14%, right? Because 1 is my principal amount today, which will become 1 plus 14%. And risk-free is 1 plus 12%, which will be multiplied with 1 plus risk premium as a percentage. Are you with me? So 1.14 is equal to 1.12 into this is your risk premium, right? So what is that percentage coming to? How do I get that? Risk premium is equal to 1.14 divided by 1.12 is equal to, you will get 1 point something something. How much is that coming to?
1.0179.
0179. Okay. So my risk premium is 1.0179. So whether I am in India or in abroad, my risk premium, because this is for ABC Limited. When I say my, meaning I am ABC Limited. So for ABC Limited, risk premium is 1.079. So what will be the foreign required rate of return? Foreign required rate of return will be 1 plus, what is in the US? US may, what is the risk-free rate? 8%. Are you with me? Into
Yes.
1.0179 because this is my risk premium. So now this is risk-free rate in US And this is my risk premium. This is risk premium not for the economy. This is risk premium for ABC Limited, which ABC Limited is expecting, right? So I want this risk premium to be there. So what is my required rate of return coming to? 1 plus, so 1.08 multiplied by 1.0179. How much is that coming to?
$1.099.
1.099. So what is FRR in that case? 0.099. So can I say this is 9.9%? Yes.
Sir, have you subtracted this one?
Yes, dear. 1.099, right? So that means I will get FRR.
9.
Chalo. 1.099 minus 1. 1 is your principal amount, right? So what is the rate of return?
0.99.
0.99, 9.90%.
Yes, sir.
Okay.
Sir, this you have told 1 is the principal amount. It means the initial investment.
Yes, that is initial investment, right? Principal plus interest will give you the maturity value, no, my dear?
Yes, sir. Yes, sir.
Shall we move further now?
Yes, sir.
Okay. So now I'm going to do calculation of NPV. Now let's do calculation. Step 3 क्या है? Calculation of NPV, right? Yeah. What is your step 3? Discount the future foreign currency cash flows using discount rate as per step 2, right? So this is something that you already know, right? So what are we going to do over here? We are going to do calculation of NPV. How? I will say here, then cash inflow in dollar. Then I need PV factor. PV factor discounting at what rate? At what rate?
9.9.
9.90%. And then I will calculate present value in dollars. So this is my column number 1. This is my column number 2. This is column number 3. This is column number 4, which is nothing but column number 2 into 3. So you are 1, 2, 3, 4, 5. What is my cash inflow? This is 20 lakhs, right? So 20 lakhs. 20. Should I do dollar in lakhs or in million? What would you like? If you want, you can write the whole number also.
Sir,
20,
write in lakhs.
20 lakhs, 25 lakhs. Confusion come hoga, right? You will be able to have a lesser confusion. Because again, if you go from 20, I mean, of course, it's your choice. But if you want to, you try to convert this, what happens is, if you are not attuned to that, you might end up making mistake. Because everything over here, numbers are expressed in lakhs.
Yes,
So
sir.
I'm keeping it as 30 lakhs. Then I have 40 lakhs, 50 lakhs. If you do it in millions also, it's not wrong. Huh? Remember that. It's just that mentally in the examination time, you will have more mental calculation to be done, right? So it's better if I keep it very simple for myself. That's the reason I'm taking this. Okay. Now here, how will I get the PV factor? PV factor is nothing but 100 upon 1 plus the required rate, right? Am I right?
Yes, sir.
And then you say it is basically raised to n, raised to n. So in the first year it will be raised to n, then raised to 2, raised to 3, raised to 4, raised to 5. Or alternatively, as a student, you also know when we are doing the calculation, for the first one we will do 100 divided by 1.099. Now you can use the constant function. I believe everybody knows how to do that,
Yes, sir.
right? So please tell me what are the PV factors we are getting.
Sir, we will take 4 decimal 0.9099.
0.90. Okay, 9099. Okay, then second
0.827 0.8280.
8280. Okay,
0.7534.
okay, 40 lakhs 0.6855.
6855.
And last one is 0.6238.
6238.
Fantastic. All right. Now we just have to multiply 20 lakhs into the respective numbers, and we will get the total proceeds. Right? It will be the total discounted proceeds. So what will be the amount coming to? Compute the numbers and then give me, because I am relying on you guys to do that for me. Okay. Now whatever comes from that we will subtract less investment. Investment was how much? $1 crore 10 lakhs, right? This is going to be all in lakhs, remember? That is the reason I am writing over here 110 lakhs. This will be NPV in dollars. Then step 4, convert into NPV rupees is equal to NPV dollar into spot rate is क्वेश्चन में ये दिया हुआ है, it is rupees 48 per dollar. Are we getting the numbers? Can you start helping me out with the numbers?
Sir, first one is 18.198.
198. Second,
20.70.
70.
22.602.
602.
27.42.
32.
31.19.
31.19.
Aggregate is 120.11.
120.11. Remember, this is in lakhs, please.
Yes.
Minus 110 lakhs. So what I get is 10.11
0.11 lakhs.
lakhs. This is my NPV. So now I have to have 10.11 lakhs. This is dollar into rupees 48. So that comes to how much?
485.28 lakhs.
485.28
Lakhs.
lakhs. This is in rupees. Please remember this, we have calculated using foreign currency approach, which was asked in the question. We will try to do the same question again now using home currency approach. Before that, shall we take a break of 10 minutes?
Yes, sir.
Ashok ji? Hello, Ashok ji. Yes, sir. Thank you, sir. Okay, so this was our question number 3, ABC Limited, which we started solving using foreign currency approach as it was asked in the question. Now we are going to solve the same question with home currency approach. Okay. Home currency approach. Okay. Now in home currency approach, remember, I have the same cash flows which are already given to me. So question number 2, the same question over here. Let me copy paste over here again, just so that we have the question before us. Okay. All right. So here, what I'm going to do is, first of all, I'm going to start with as per currency approach right now. So I have home currency approach. Step 1. What is step 1? Again, identify the cash flows in foreign currency. This is already given. Step 2. Now, this is my first question on both the approaches with you guys. That is the reason I'm writing over here step 1, step 2. Examination, you don't need to write step 1, step 2. You'll obviously start doing the computations. Okay. This is basically for your easy reference. All right. Now, in step 2 for home currency, I need to identify what will be the forward rates, future forward rates, right? Because I know the spot rate. I need to find what is the spot rate given to me. Spot rate is
48 per dollar.
48 per dollar. I want to find forward rates. So I will have to find forward rates, right? So I have to find that at the end of year 1, year 2, 3, 4, and 5 respectively. So how do I go about finding that? Now here we are given risk-free rate of the two economies, 8% and 12%. So we are going to use the principle of, we have to use purchasing parity, right? So purchasing parity mein, I don't have inflation numbers, I have interest rate numbers. So I will use interest rate parity. Now pay attention, how you calculate forward rates, right? So how do I calculate forward rates? My spot rate is 48 upon 1, am I right? 48 upon 1, it is $1, 48 rupees per dollar.
Yes,
Multiply that by the respective interest rate. So INR is 48. This is rupees, right? This is dollar. So 48 into 1 plus, what is the interest rate of INR? 12%.
12%.
Divided by 1 plus
8%.
8%. Right? So in other words, I can simplify this as 48 into 1.12 divided by 1.08. Are you with me? Okay.
Yes, sir.
So what is this number? Now remember, whatever is this number for the year 1, that will again be multiplied with 1.12 upon 1.08. So this number can be made as a constant. Other than writing raised to 3, 2, raised to 3, raised to 4, you can make that number as a constant, right? So here I will write, if you are going to write over here 48, again original spot rate, then I will obviously have to say over here raised to 2, right? If I say spot rate over here 48, 48, 48, then I'll have to write this to 3, 4, 5. From practically computation perspective, 1.12 upon 1.08 should be made a constant, right? So press into, then type 48 equal to. Then just equal to, and you should get the values. Yes, tell me, what is the number value we are getting? $49.78. Please check, is this the value which you are also getting? So I'm getting over here 51.62, 3.3. Then I have 5.51, and then I have 57.57. So I have got the forward rates of the 5 years. Are you all with me?
Yes, sir.
Yes, sir.
Okay, all right. So now, what is my step number 3? What is my step number 3? I have to find discounted cash flows, right? In the discounted cash flows in the Indian currency. So first of all, I'll have to take these cash flows, convert them into the INR using these forward rates, and then try to find the NPV. Okay, all right. So what are the columns I'm going to need over here? I'm going to need over here year. Then I have forward rates. Forward rate कहाँ से मिलेगा? We have already calculated that. Then I will need to convert the cash flow. First of all, this is given information, cash flow dollar. Then I will find cash flow in rupee. Then I will need the PV factor at, what will be the discounting factor over here in INR? What is the required rate for INR?
14%.
14%, very important. And then PV. Okay. So I have column 1, column 2, column 3, column 4, which is nothing but column 2 into 3. Right? And then I have column 5, and then I have column 6, which is 4 into 5. Here 1, 2, 3, 4, 5. Okay, let's write down the rates. 49.78. Next is T1.62, T3.53, T5.51, and last one is 57.57. Okay, now cash flows. What are the cash flows? Cash flows are given to us. This was 20 lakhs, then 25 lakhs, then 30 lakhs, 40 lakhs, 50 lakhs. Now do the multiplication and give me these numbers over here.
995.6. 95.6.
995.6. Okay.
20 into
995.
49.78, na, sir?
Okay, yes, sorry. Barabar. So this will be 995.6 lakhs, then 51 into 25, so that will be
1290.5 lakhs.
1290.5 lakhs. These are rupees in lakhs.
Yes, sir.
Okay, lakhs. Okay.
Third one is 1605.9.
1605.9
9.
lakhs, yes.
Then 222.0.4.
4 lakhs, very good, thank you. And the last
Then
one?
2878.5.
2878.5. Okay. Now I need PV factor. So how will I get PV factor? It will be, first one will be 100 upon 114. Right? And then keep dividing that number by 114, or you can say 1.14. Yes, tell me.
0.877,
0.877,
0.769,
0.769,
0.675,
75,
0.592,
2,
0.519.
519. Okay, fantastic. So now I have to multiply 4 into 5. So 995.6 into 0.877,
873.14,
873.14,
992.39,
992.39,
1083.98,
1083.98,
1314.48.
0.48,
Yes. 1493.94.
14.
93.94.
So total comes to how much?
5757.93.
5757.93.
0.93.
This is rupees in lakhs. Again, I will write over here also rupees in lakhs. Okay. All right. Less investment. Remember, investment was 110 lakhs in dollars, right? So into, since I have converted everything into present value, I need to do that at spot rate today, 48. So that comes to how much?
5280.
5280.00. So what is the excess?
477.93.
477.93. Okay, this is net present value in rupees. This is your home currency approach, and earlier we had done foreign currency approach. So because of our rounding of factors and obviously the forward rates being involved, there is a possibility of some differences being there. But generally, decision will not change just because which currency you are following or which method you are following. So earlier we were getting what? 485.28 lakhs. Now we are getting 477.93 lakhs. Has everyone got this?
Yes, sir.
All right. So let us do one more question where we are going to do both the methods. So on page number 5, you have question number 8. Page number 5, you have question number 8. Let me take that question over here. Is question 8 visible to everyone over here on the screen?
Yes, sir.
Okay, all right. Let us start with question number 8. So, this is the question where we are again going to do by both the methods, and most important aspect is over here is we need to essentially, whatever we have studied in the previous question, that was a start for us. So now we are going to essentially cross-check how much we remember, and we are going to apply in this question. Again, both the approaches. Of course, in the examination, not always that you will have both the approaches. In this question, this is an adapted question from earlier ICAI examination. So here you are being asked both the approaches, but generally both the approaches are not being asked. It's generally one of the approaches, right? But you need to know both the approaches. Let's start. VK Limited is considering an investment in Sri Lanka involving an initial investment of Lankan rupees 25 billion. Current spot exchange rate is INR upon LKR is 0.37. The risk-free rate in India is 6% and same in Sri Lanka is 5.20%. The project will generate a cash flow of LKR 5 billion in the first year. Cash flow will increase by LKR 1 billion each year for the next 4 years. In other words, it will be 5, 6, 7, 8, 9 billion, right? Project will bind up on completion of 5 years. It is not bind up, it is bind up on completion of 5 years with no salvage value. So this will be not bind, it will be bind up. Okay. Please make this mind correction. On completion of 5 years with no salvage value. The required rate of return for the project is 8%. You are required to find out the investment worth of the project by home currency approach, foreign currency approach. Compare the outcome under both the approaches. You are given 1, 2, 3, 4, 5. PV factor is already given to you at the rate of 8% and at the rate of 7% respectively. All right, shall we start? Yes. Which approach do you want to start first? Foreign currency approach or home currency approach?
Home currency.
Home currency. Let's start with the home currency approach then. Okay, so first is home currency approach. So first and foremost, step 1, identify what are going to be the cash flows. So we have what cash flows over here in the 5 years. It will start with 5 billion and then it will be 6, 7, 8, 9 and 10. Sorry, I have 5 years. So let me take it over here. Here, 1, 2, 3, 4 and 5. So what is going to be my cash inflows? Cash inflows I am told is in Lankan rupees, right? So this is in LKR billion. Okay, all right. 5 billion, 6 billion, 7 billion, 8 billion and 9 billion. Right? This is my step 1. What is my step 2? Step 2 is I need to identify the forward rates, right? Yes. What will be my forward rates? Forward rates.
0.37 into 1.06 divided by 1.052.
Remember, it is 0. Spot rate. This is your spot rate, 0.37 upon LKR 1. Right? Generally, a lot of the time, students get confused, sir, what should be the numerator and denominator? Keep it very simple. This is INR upon LKR. So I need to multiply it with the rate of interest of INR will come at the top, right? So what is the INR rate? Risk-free rate in India is 6%. So this will be 1.06 divided by
1.052.
1.052. Yes. Right. So you just need to multiply this with 0.37 into 1.06 upon 1.052. So second one will be 0.37 into 1.06 upon 1.52 all raised to 2 to 1.06 upon 1.52 0.52 raised to 3 and 0.37 into 1.06 upon 0.52 raised to 4 raised to 5. Okay, so what will be the rates?
0.3728,
0.3728,
0.3756,
0.3756,
0.3785,
3785,
0.3814,
3814,
0.3843.
0.3843. Okay, so I already have now the forward rates for the 5 years. Now it is quite, stepwise when we are considering, they are given in different steps. Can I actually continue the same table over here? Can I continue the same table over here? Or do I need to make a fresh table?
Continue, sir.
In
I can
convert the
continue the
same.
same table over here. What will
Yes,
I need to do now? What
Continue.
are going to be my columns now? Now I will need to use this forward rate and
Cash flow in
cash
rupees.
inflows in
Home currency.
Rupees.
right? Now since this Lankan rupees are in billion, obviously Indian rupee also in billion, right? Okay. All right. Let's start. I'm going to multiply 5 into 0.3728.
1.864.
1.864. Okay.
2.2536.
2.2536.
2.6495.
2.6495.
95. Yes.
95.
3.0512.
3.0512.
3.4587.
4587. Okay, now I have got the cash inflow. I need to multiply it with the PV factor. PV factor at what rate?
8%.
Yes, PV factor at what rate?
8%.
Yes. Remember, we are doing this in Indian currency, so I will need to take PV factor at 8%, right? It is given in the question to me. Now, do I need to even calculate these numbers? I am already provided these numbers, right? The question. So I can use these numbers over here, which are already given to me. 0.92593, 0.92593. Second one is, what is the number? Second one. What is the answer you're getting? Is anyone trying already? So it's 0.92593, then it is 0.85734. Then I have 0.79383, 0.73503. Then I have 0.68058. Okay. Now I would need present value. PV. PV is nothing but multiplication of cash inflow into PV factor. Yes. Please tell me these numbers now.
1.7259,
1.7259,
1.9321, 2.1032,
2.2.2.32,
1032, 2.2427,
एक मिनट बेटा. This is third year, right? 2.6495 to 0.79. We are getting 2.1032.
32,
Okay.
2.2427,
2427. And the last one,
2.3539,
3539. Okay.
10.3278,
All of you, please check if there is any typo error by us, then you can always help. Yes,
3278.
10.3278. Now from this, I will say less investment. What is my investment? Yes, what is my investment? Question में क्या लिखा था? Question में लिखा था. Question में लिखा था.
9.25, actually 25 into 0.37.
Question में क्या लिखा था?
Sir, Sri
25
Lanka.
million LKR, right?
Yes.
25 million LKR. So 25 into, you will have to multiply that at the spot rate.
Yes, sir. 0.37.
Yes, so 25 million into 0.37.
9.25.
9.25.
5.
So that is
1.1085.
07. 1.07, 1.08.
077, sir. That is 08 also you can write.
This is 9.25.
That is 9.25 only, sir.
Okay, 9.250. Okay, all right. And this is 1.0778.
Yes, sir.
Okay, this is NPV, right? In rupees. This is home currency approach. Now we will go and do it in foreign currency approach. Foreign currency approach, again, first step is same, year and cash inflows. That is already given to me. Okay, so that is not a problem. Now I need to find what is the new required rate in Lankan currency. So for that I need to find risk premium. Is this over? Can we start with foreign currency approach now?
Yes, sir.
Okay, all right. So let's start with the foreign currency approach then. Foreign currency approach. Yes. Start over here. Foreign currency approach. First of all, I need to find required rate of return in foreign rate. So my required rate in Indian terms is 1.08 is equal to 1.06. This is my risk-free rate, right? Multiplied by 1 plus risk premium. So your risk premium is coming to how much?
1.0189.
1.08 upon 1.06 is equal to 1 plus RP. And this is equal to 1.0189.
189.
Okay. Now, what is the discount rate? So, discount rate,
5.2.
rather required rate of return. Let me write it as required rate of return. Required rate of return in Lankan rupees, right, is equal to
1 plus
0.052
105.
into 1.0189. Am I right?
Yes, sir. 1.0719
1.0719.
or 7.19%.
719. So that is 719%, right? 7.19%. So we take this to be approximately equal to 7% right now, because we are given the rates of 7%. Remember?
Yes, sir.
Okay. So we take this as 7%. All right. Now I can start calculation of. So here, what will be my columns? I will have cash inflows, right? I have the required rates. I will calculate the new discount factors or PV factor as per 7%, which I already know over here. And then I will calculate cash inflows in Lankan rupees. That is present value in Lankan rupees. Is your cash inflow in LKR, PV factor at 7%, and then I have present value. So here 1, 2, 3, 4, 5. 5 billion. This is Lankan billion, right? This will be LKR billion. 6, 7, 8, 9. PV factors are already given to me, so I can just copy paste it and write it over here. 0.93457. 0. 0.8160. 0.76290. And last one is 0.71299. So what is the PV I get?
4.67285.
4.67289.
285, sir.
285. Just 1 minute. 285.
5.24064.
5.24064.
24064. 5.7141. 6.1032.
103.
2.
Okay.
6.41691.
41691.
Total 28.1477.
477.
Less investment 25.
Yes. Less investment 25.
3.14.
1477. This is NPV in Lankan rupees, right? I need to get now NPV in rupee is equal to NPV in Lankan rupees multiplied by spot rate. That is 3.1477 into 0.37. That comes to how much?
1.1646.
1.1646.
1646.
This is rupees billion. Here also asked one more question over here, right? To compare or something like that. Yes, we are asked, what was the question being asked to us? Compare the outcome under both the approaches. Are we having positive NPV in both?
Yes, sir.
So, first and foremost, so should you accept the project or not? That is the first question.
Accept.
The positive
In both the
NPV.
cases, we will say accept the project since NPV is positive, right? And then I have to compare the two approaches. So both the approaches are providing positive NPV. Yeah. Now you might say, sir, why don't you compare 1.1646 minus whatever 1 point earlier we had found? What had we got the answer earlier? Here it was 1.0778. Okay. And here it is 1.16. So I'm not going to do any subtraction addition for the simple reason. We had got the rate of 7.18, 7.19% over here, remember? And yet we
Yes,
took
sir.
7%. Because we had the discounting factors of 7%, so we took 7%. Probably had you discounted it with 7.19%, higher the discount rate, values would have come lower, right? So probably your difference would have gone lower, right? It would have been a lot closer. So what is important is both the approaches are providing positive NPV. So accept the project. Okay. Next question. Next question we will take is Sure. Okay, question number 4. Question number 4. Question number 4. Okay, question number 4. Question number 4. A USA-based company is planning to set up a software development unit in India. So project is going to be in India and the domestic country is USA, right? All right. Software developed at the Indian unit will be bought back by the US parent at a transfer price of US dollar 10 million. The unit will remain in existence in India for 1 year. The software is expected to get developed within this time frame. US-based company will be subject to corporate tax of 30% and a withholding tax of 10% in India. That will not be eligible for tax credit in the US. The software developed will be sold in the US market for US dollar 12 million. Other estimates are as follows. Rent for fully furnished units with necessary hardware in India, 15 lakhs. Manpower cost, 80 software professional will be working for 10 hours each day, rupees 400 per man hour. Administrative and other costs, rupees 12 lakhs. Advise the US company on the financial viability of the project. The rupee dollar rate is 48 per dollar. Assume 365 days a year. All right. So here what I have to make is, first of all, I'll have to make a pro forma revenue statement, or you can say profitability statement, right? Or you can say P&L account as the case may be. So let me make over here forma profit loss. Okay, is this visible to everyone? Or should I increase the size even further? Font size.
Yes, sir.
Yes, easy to understand?
Yes, sir.
Okay, all right. Now, okay. So, profit and loss account, we are doing it for which unit? For Indian software unit. Okay, all right. So here I will have particulars. I'm going to write in rupees terms. All right. So to start with, what is my first cost for revenue which I am going to add? So sales or revenue. the revenue value going to be?
10 million, sir, is the transfer pricing.
10 million. That is a transfer price, right? Remember, you are able to sell it for 12 million in the US market, but that will be done by the parent company, right? And as per transfer pricing, the pricing is going to be 10 million. So in India, they will recognize only that part of the revenue. Okay. So at the spot rate, this comes to how much? 10 million into 48. So that is
480 million.
4 crore 80 lakhs, everyone. 10 lakh into 48. Yes. Let me put this over here into formula text so that you have that also. Okay. All right. Now, less costs. Which are the costs which are there? First is
Rent,
rent of rupees
15 lakhs.
is rupees 15 lakhs. 15 lakhs. 15 lakhs. Okay. Then manpower cost. Manpower is going to cost how much? Manpower. Pay attention. Manpower is costing how much? 80 software professionals. So you have 80 professionals working for 10 hours each. For 10 hours each day into
365 days.
400 per hour into 365. Okay. Now here, please don't assume that, sir, every week one holiday is there, etc. Why? Because the project for year has been clearly mentioned. It is 365 days a year, right? So don't get any other assumptions in place. Okay. All right. Next, after manpower, you have administrative and other costs. How much is that? 15 lakhs again? No, that is 12 lakhs. 12 lakhs. Any other cost remaining? Any other cost remaining?
No, sir.
No. So I will say total cost is coming to how much? 15 plus 1168 plus 12 lakhs. So 1195 is the total cost. Okay. So 480 minus 1195. This is called what have I done? उल्टा कर दिया क्या? ये मैंने कुछ गलत किया क्या? 1 2 3
One more zero to be added, sir.
हाँ. Okay, all right. This is earnings before tax. Now here EBIT and EBT are same because there is no interest cost. Okay. So from that, first of all, now you are told withholding tax is there. How much is withholding tax?
10%.
Withholding tax is at 10%. So first of all, obviously, you will have to pay withholding tax, right? At 10%. So how much will that be? 3605 into 10%. Okay, now on this, once the entire computation has been done, you will pay your corporate tax. How much will be corporate tax?
30%.
30% is corporate tax, but you have already paid out of that 10%. Am I right?
Yes, sir.
Okay. So, in other words, I am going to pay balance 20%, right? Equal to 20% balance. Again, so this will be again 20% of what? Remember, this is a matter of presentation. Huh? 0.20. It is 20% of 3605 on earnings before tax. Minus tax, I get 25 crore, 23 lakhs 50,000. This is called
Earning after tax.
earnings after tax. Right? Now, as a US entity, obviously you want to repatriate the entire proceeds, right? So, earnings after tax, you want to repatriate. Because after the year, you can see it is only a 1-year project, right? Thereafter, there is nothing else remaining. So, obviously, you want to take the entire proceeds back. So, repatriation in USD will be how much? It will be equal to 25, 2350 divided by 48. Am I right? Would it be right to say it is divided by 28?
Yes.
Hello.
Yes, sir.
So at the year end, should we consider the rate changes? Forward rate.
Yes, but nothing has been mentioned to us, right? With regards to interest rate or inflation or any such estimates. So then I have to go by the original rate.
Okay.
Had the interest rate, you are right. Had the interest rates being provided to us or inflation rates being provided to us, then we would have used the purchase power parity or interest rate parity and tried to find the forward rate 1 year from now. Okay. Okay. Now this is repatriation in USD. I also want to find in that case cost in USD. How much is cost in USD? Can you tell me that? 10 million was your project revenue, right? Which you had identified. Out of which, after incurring all the cost, you are going to get 52. So what is the cost which you have recognized? Total cost? It is 47, 42, 708. Are you all with me in USD terms?
Yes, sir.
Right. Now, so you are essentially having a cost of 4.74 in USD. And what is going to be your revenue for a parent company? Yes. Parent
12
company will sell it for what value? 12 million, right?
million.
In the US market, you will sell it for 12 million. So in that case, advise the US company on the financial viability of the project. So what will be your advice?
Accept the project.
US company will be able to realize USD 12 million for a software which cost USD how much? 74 million. Am I right? Thus, company should क्या?
Accept
Accept the project.
Yes, should accept the project. Okay. All right. Shall we take up one more sum? Trying to find a question which we can do in the next 15 minutes. Just 1 minute, please. All right, let's do this question. Question number 5. Question number 5. Question number 5. All right. Question number 5. XY Limited is engaged in large retail business in India. It is contemplating for expansion into country of Africa by acquiring a group of stores having the same line of operation as that of India. The exchange rate for the currency of the proposed African country is extremely volatile. Rate of inflation is presently 40% a year. Inflation in India is currently 10% a year. So here you are given inflations. Management of XY Limited expects these rates likely to continue for the foreseeable future. Estimated projected cash flows in real terms in India as well as African country for the first 3 years of the project are as follows. So year 0, you are told at the beginning how much is the cash outflow in the respective currency, right? And then we are also provided further information for the first 3 years of the project are as follows. XY Limited assumes the 3-year nominal cash flows will continue to be earned each year indefinitely. It evaluates all investments using nominal cash flows and a nominal discounting rate. The present exchange rate is African Rand 6 to Rupee 1. You are required to calculate the net present value of the proposed investment considering the following. African Rand cash flows are converted into rupees and discounted at a risk-adjusted rate. All cash flows for these projects will be discounted at a rate of 20% to reflect its high risk. All right. So here you have to follow which method? The first point is saying African Rand cash flows are converted into rupees and discounted at a risk-adjusted rate. So you have to do the calculation in home currency or in foreign currency. Hello.
Foreign currency, sir.
You are given cash flows, African Rand cash flows are converted into rupees and discounted at a risk-adjusted rate. What is your steps? Remember, what are your approaches? You are going to convert a foreign currency cash flow into domestic currency as per which method? Foreign currency method or home currency method?
Home currency method.
Yes?
Home currency method.
In home currency method, you get the foreign currency rates. You are essentially not converting the cash flows into home currency, yes. So in home currency, because you are going to express everything in INR terms, so you have to take your South African Rand cash flows, find the foreign exchange forward rates. So here you will use which particular parity principle, IRP or PPP? We are given here inflation. So we will get based on purchasing power parity, we will find the future exchange rates for the 3 years. Based on that, thereafter, we are going to convert future cash flows of African Rand into home currency, and then you are already given home currency discount rate is 20%, which is required rate of return. Right? So let's start. Let's start. All right. So okay. So here I have your cash flows are already given to me. Yes. Your and 1, 2, 3. What is my cash inflows or cash flows rather? So I'm writing in which currency? African rand, right? Okay, so now here in cash flow, I have 2 lakhs. Then I have 30,000. Then I have 70,000. And then I have 90,000. Okay. I need forward rates. Forward rates. So here, first 2 lakhs will be converted at the spot rate. Am I right? What is the spot rate? The present exchange rate is African rand 6 to 1. This is African rand 6 to 1. So, yes, African rand 6 to 1. So, when I am converting this into
1 by
INR,
6.
I have to write 1 upon 6. Am I right?
Yes, sir.
1 upon 6. This is rupee upon SAR. Okay, all right. Now, 1 upon 6. I will have to multiply this with the respective inflations. So, inflation in India is 10%. Inflation in South Africa is 40%. Am I right? African nation. So 1 upon 6 into 1.1 divided by 1.4. 1 upon 6 into 1.1 upon 1.4 cube. Okay, so I'll get thereafter cash flow in rupees. Right? This is the converted cash flow. But there is also another cash flow which is happening in India as well, right? Estimated projected cash flows in real terms in India as well as African country for the first 3 years. So you are going to have some cash flows in India as well, and these are all outflows. So I'll have to add those outflows. Am I right? चलो कितना वैल्यू आ रहा है फॉरवर्ड रेट्स कितना आ रहा है प्लीज गिव मी द फॉरवर्ड रेट्स
0.1309
0.130
or 10 we can take, sir.
what is this
13095.
0.13095 okay and this one
0.10289.
0.1
0289.
289 and this is 0.0808
0808.
and what is the first one coming to 1 upon 6
1 upon 6 is
0.16
0.1666.
666 okay all right so let's multiply now these numbers with the respective forward rates so that you will get the cash flow let me start taking numbers like this that will improve our speed so minus 2 lakhs into 0.166 right then second one is 50,000 to 0.13095 and I have 70,000 into 0.10289 then I have 90,000 into 0.0808 okay all right these were converted cash flow in rupees then you also have cash flow in rupees only right which was in India What is that cash flow? What is that cash flow? Look at the question. We have minus 50,000, 1,500, 2,000, 2,500. Minus 50,000, minus 1,500, minus 2,000, minus 2,500. Okay. So total cash flow in India. Total cash flow in rupees. How much will that be? Equal to this plus this, right? A equal to do we have any other cash flows over here? Sorry, my system is a little bit slow. Sorry. Yeah. XY Limited assumes the 3-year nominal cash flows will continue to be earned each year indefinitely. It evaluates all investments using nominal cash flows and nominal discounting rate. The present exchange rate is African Rand 6 to 1.
Indefinite means after from 4th year we have to take that 3rd year cash flow.
Yes. So how do we go about doing that? We will have to essentially do compounding part right over there. Because after a certain period, you are going to obviously keep receiving this in perpetuity. Am I right?
Yes, sir. I think we'll have to convert this into nominal cash flows over here.
So that he can essentially apply the discounting rate there. Otherwise, will not be able to apply that. It's already 10 o'clock. Let us continue this question in the next session on Monday, and then we'll continue with the other questions as well. In the meantime, I will also add over here some columns over here because we have to take the nominal values, right? Because we will need to take nominal values for both my Indian outflows and for my African outflows, both. Otherwise, I will not be able to apply the compounding factor over there because it is going to continue in the indefinite period, right? So we will continue with this question in the next session, right? It's already 10. It will take at least 15-20 minutes more. So it is not advisable right now. Let's take it in the next session. We'll start with this question and then we will take up the subsequent questions. Okay. All right. Shall we stop over here? Ashok ji? Yes, sir. Yes, sir.